Well, let's focus on our next corporate, Godrej Consumer. Their Q1 FY24 update came in. That indicated that sales growth has been in double digits in the first quarter of FY24. That's on a consolidated basis. They also see sales growth to be in double digits. To discuss this and more on their international business, we are joined by Sameer Shah, the CFO at the company. Hi, Sameer. Good morning. Thanks so much for joining in. Well, let's focus on the India piece first. How has growth been across the various segments? Soaps, liquid soaps, hair color, as well as household insecticides. Could you tell us which segment has grown faster? And also, will India's revenue grow ahead of volumes?
Good morning, Nigel, and thanks for having me on the show. If you look at our performance in India last quarter, it has been quite steady. I mean, to begin with, we had double-digit volume growth, and the growth was also very broad-based between home care and personal care. In fact, home care growth was even better. It was somewhere around mid-teens in terms of volumes, and personal care volumes growth was higher than mid-single digits. The overall value growth was tad lower. That's because we are passing on the benefits of lower commodity prices, especially in categories like personal wash to the end consumers, which is resulting in lower pricing. But net-net, the overall quarter performance was extremely steady to strong for us.
And will the revenue grow ahead of volumes? Getting back to that earlier question, Sameer. And also, if you could throw light on the rural demand, what have you seen in the last 3 months and your expectations going ahead?
So at this point in time, we expect the volumes growth for us to be ahead of value growth for the simple reason that we have taken price cuts in categories like personal wash, which is also driving market share gains and strong volumes growth for us. My sense is towards the end of the year, this will anniversarize and hence the value volume growth should start merging in. I think for us, the rural demand was steady. Honestly, we may not be the best proxy for rural demand because our rural salience is around 27-28% compared to FMCG universe, which is around 35 to 40%. And the overall FMCG did get impacted because of untimely rains. But for us, the performance was steady, I would say, though urban did much better than rural for us too.
Sameer, hi, morning. So you're saying that by the end of FY24, value growth should start to outpace volume growth.
It will start merging around. It will start merging, and then my sense is there will be pricing mix-led growth, which should result in value growth ahead of volumes growth.
Okay. What was the contribution of Raymond consumer business? There was some 6 to 7 weeks of consolidation for the quarter.
Yeah, so the growth which I mentioned earlier in India, the double-digit volume growth is all organic. I think Raymond's contribution would be maybe around 3 to 4% in the quarter to India business, and would be around 1.5% to 2% to the overall global business for us.
Okay, all right. Sameer, your gross margins, they will likely see an expansion, right? Input costs have gone down. How much of that will be reinvested in ad spends? If you could give us a rough number, how much ad spends are as a percentage of sales in the last year? And will you be looking to up that because now your gross margins will be higher?
Yeah, so gross margins have seen significant expansion and we are quite pleased with the quality of profits, which is gross margin expansion, increase in media investments, which in turn drives strong volume growth, lower controllable cost and healthy profitability. So gross margins, my senses will see anywhere between 800 to 1000 bips of expansion on a YOY basis. We also had a relatively low marketing spends in the base quarter. But we will, kind of see again meaningful increase in marketing spends. My sense is it will be close to around 10 to 11% as a percentage of sales. And with lower controllable cost, we still expect very healthy EBITDA growth. And not just this quarter, but my sense is, Nigel, even for the rest of the year, we will continue to see this kind of trajectory, direction-wise at least, healthy gross margins, higher marketing investments, lower controllable cost. And by the way, we are also investing part of gross margins towards price drops, especially in personal wash category, which is again driving good market share gains and volumes for us.
You're saying gross margins in Q1 are 800 to 1000 basis points higher on a year-on-year basis?
Yes, that's right.
Okay. And going ahead in Q2, do you think directionally gross margins can be higher than what they are in Q1? And you spoke about using that leverage to cut prices. Where else are we likely to see a drop in prices going ahead?
Yeah, so I think gross margins on a YY basis, Reema, will continue to expand. I'm not sure on sequential basis because in FMCG there is always a little bit of seasonality. So there will be a mixed impact over there. But we will continue to see, even for rest of the year, we remain extremely confident that we will see gross margin expansion and a meaningful one. And we will continue to invest for growth because we do want, this to be like a flywheel where you have gross margins expansion, you invest for growth, you get volumes, you get scale, you have lower cost and healthy profitability. So that's the model which we are working with. I think so far so good in terms of Q1 as well as Q2 looks like. And hopefully we will be able to replicate this for rest of the year also.
Sameer, some of the African markets have been in a bit of an upheaval, political led, and then, of course, the economic impact, Nigeria, etc., especially. How do you see, those markets panning out for you? Those are big markets for you for the rest of the year, FY24?
Yeah, so I think again to begin with, Prashant, if you look at Q1, Indonesia has done extremely well, though on a low base. We did have mid-teens constant currency growth rates and good profitability. Again, we expect that trend to continue for rest of the year. Africa also, did see low teens constant currency sales growth and with adverse translation impact, high single digit value growth. Nigeria is around 5-6% to our global business. We did see a sharp currency devaluation. There are multiple impacts. The first is translation, which is a non-cash impact. So that doesn't impact, the cash flows as such. The second is inflationary impact because the cost of purchase will go up, but we remain extremely confident in terms of mitigating it by either passing it to the end consumers or reducing down the overall controllable cost to continue with our ambition of Africa as a region reaching to 13-14% EBITDA margins in FY24. The third is actually it creates, a competitive landscape for us because there were a lot of players in the earlier regime who were able to get dollars at much lower rates as compared to most of the organized players like us. And now in the new regime, there is a significant competitive advantage. So we do expect significant market share gains also because all the players will be in the same boat in terms of cost of purchase going ahead.
Sameer, give and take everything. For the year, what kind of numbers are you looking at in terms of a volume growth, revenues, margins? If you could give us a rough sense for the year. You're in silent period, so don't ask you anything about Q1. But for the year, what kind of a target do you have?
So Nigel, we had, shared recently in our strategy discussion with market participants of full year guidance, which was for high single digits volume growth and high teens EBITDA growth. I think we're very much on track in terms of high single digits volume growth, the way things are at this point in time for rest of the year and hence for FY24. My sense is on profitability, maybe we'll do better than high teens EBITDA growth, should be close to around 19-20%. Again, the way things are at this point in time.
I know for you, rural market is not as big as it is for other FMCG players, but if you could just provide some industry color. Has rural demand in Q1 been weaker than what we had in the March quarter?
So again, not sequentially, but in terms of trends, Reema, the rural demand has been, kind of softer. We did see a little bit of spurt somewhere around the Diwali period, but post that, rural consumption has been, sluggish. We expect gradual recovery, but the recovery has been extremely gradual. It's getting pushed, honestly, by few, months and maybe a quarter or so almost, over last 6 odd months. But now, assuming that monsoon is, kind of fairly decent and also in run up to elections, if we are going to see, which typically happens, higher social welfare spendings, there should be increase in rural consumption. And also, by the way, it will be on a weaker base. So net for rest of the year, even for FMCG, we do expect gradual recovery in rural. And then it gets complemented by steady state performance in urban. So in fact, kind of CRISIL reported, I think yesterday or today, that they are looking at higher than mid-single digit value growth for FMCG in FY24. And we do, believe that for the sector, to clock higher than mid-single digit value growth for FY24 should not be that difficult either.
Okay, Sameer, we'll leave it there. Thank you very much for your time. Appreciate you joining in with that perspective. Good luck to you as we look forward into the rest of FY24. The market